Just a second, sir. Just a second. Okay, sir. Please, sir, start, sir.
Good evening, dear friends. Today we are again meeting in our second session for today. First in 2 to 4 due to some health issues with your indirect tax faculty. We conducted 2 to 4 for direct taxation paper 7, and again at this is scheduled class 5 to 7 direct tax paper 7. We are here again. So let's start. Uh, my screen is visible to you. And am I audible? I think yes, I'm audible. Today we are going into a very theoretical chapter called income exempted from tax. The income exempted from tax means few incomes which are not supposed to be taxable is listed in section number 10. We are supposed to discuss few of them in this session. That means this income which we discussed today are enlisted in section number 10. No income tax is supposed to be payable on those income. Those income are totally exempted from tax. Okay. Where it is mentioned, where it is listed in the Income Tax Act, section 10 provides a list of income on which no income tax is supposed to be payable. That means these incomes are exempted from income tax. Okay, first we already know that agricultural income we discussed in our afternoon session, agricultural income section 10(1), but this is subject to certain peculiar type of taxation will be involved if few conditions are fulfilled, which we already discussed in our afternoon session. Hopefully it is fine with you. If you have any query from this part, please raise. And number 2, member shares in income of HUF. What is it? Suppose there is an HUF of XYZ. Okay, XYZ is an HUF. HUF is earning, say, during the previous year, HUF earned rupees 5 lakh as his income. Okay, I'm making it 6 lakh. On this 6 lakh, HUF is supposed to pay certain tax. How it will be taxed? How tax will be calculated? It will be calculated at slab rate, which is applicable to an individual. That which individual? It is senior citizen, super senior citizen, or other. It will be other. We are supposed to calculate tax on 6 lakh which was earned by XYZ HUF. Income is rupees 6 lakh. We are supposed to calculate tax thereon. I think tax will be 32,500 into 104%. Since HUF has already paid tax on this income of rupees 6 lakh, now what happened? XHUF is distributing this income to their members. Who are their members? Say XYZ are their member. XHUF is distributing this profit, their profit, to their member. Say they transfer rupees 1 lakh to X, 1 to Y, 1 to Z, showing that this is the share of profit from a income of HUF. Now, since XHUF is already paid tax, now 1 lakh is received by Mr. X. Mr. X received 1 lakh as a share of profit from HUF. What will be the tax treatment of this? Whether it will be treated as income of Mr. X, and again Mr. X is supposed to pay tax on this. Say apart from this, Mr. X income is rupees 5 lakh. Apart from this 1 lakh, Mr. X has also earned rupees 5 lakh. Can we add this 1 lakh as his income and say that your income is 6 lakh and accordingly you are supposed to pay tax on 6 lakh? Is it so? If we include this income in Mr. X computation, can we say that we are paying double taxation? Once this 6 lakh was paid, on this 6 lakh, XHUF has already paid tax of rupees 32,500 plus cess. Now, if it is again taxed in hands of Mr. X, it will be considered as double taxation. So what they decided, what income tax law is decided, they say that if any share, any income of HUF is distributed among members, that means member shares is not separately taxable. It will be exempted in hands of recipient, that is member. That means this 1 lakh is exempted income and Mr. X is supposed to pay tax on only rupees 5 lakh. Any question? Any question from it? Oh, someone is asking that in 2 to 4, what you have completed? We did some agricultural income and income deemed to accrue or arise in India. Hopefully video will be available after a couple of days. You may go through with that. Is it clear to you? Now come to our next point. On the same line, share of profit from a firm is also exempt under section 10(2)(a). What is it? Suppose a partnership firm is there. Partnership firm earned rupees 1 lakh. They paid rupees at the rate of 30% as a tax plus cess. Okay, now this profit is supposed to be distributed among partners. Say partners are Mr. A and Mr. B are there. They distributed profit after tax of rupees say 30,000 for the sake of round off. For the sake of simplicity, I'm considering 70,000 after tax. Say they distributed 35,000 here and 35,000 here. Other income of Mr. A is rupees 10 lakh. Can we levy tax on 10 lakh 35,000? Can we calculate tax on 10 lakh 35,000 for Mr. A or only on 10 lakh? Since the firm has already paid tax 30% on income of rupees 1 lakh, mere distribution of it to their share to their members, this income, this distribution is not considered as a income of Mr. A. This will be treated as exempted income in hands of partners, that is Mr. A and Mr. B. Henceforth, in hands of Mr. A, only rupees 10 lakh shall be considered as his income and he is supposed to pay tax thereon. Clear? Any question? Any question? If we see this, or sure, there is no issue. There will no harm. If you go with agricultural income afterwards, it is not issue for you. After this class, all classes you should attend regularly. Okay. Next one. Allowance or perquisite paid outside India by the government to a citizen of India for rendering service outside India. We discussed that there are 2 lakhs of income. An income have 2 lakhs, accrue and received. If either of the lag is located in India, then this income shall be taxable across the category. Here accrue include deemed to be accrued. Deemed to accrue or arise in India. What is it? Though few transactions are not accrued in India, but for the purpose of income tax, these listed items are considered, are forcefully deemed as an income accrued or arise in India. It is covered under section 9. In one of the item, we know that in section 9, if you are a government employee, you are an Indian citizen, you are working outside India, then whatever you are getting as a salary is considered as income deemed to accrue or arise in India, and accordingly you are liable to pay tax in India. Got it? What I'm trying to say, if you are a government employee and you are a citizen of India, that is Indian citizen, and you are working outside India, Suppose, for example, Mr. A is a government employee as well as Indian citizen. He is working as Indian Embassy in Indian Embassy, USA. Who will pay salary to him? Who will pay salary to him? He is a government employee, Indian citizen working in USA, that is outside India. Who is supposed to pay salary to him? Government of India is supposed to pay salary to him. Since all these conditions are fulfilled, though he is working outside India, he is receiving this salary in USA account. So technically, income is not accrued in India, not received in India. Henceforth, it should not be taxable in India. But due to this dimming provision, which is covered under Section 9, what it states, if these three conditions are satisfied, then whatever he is getting as a salary from Government of India is treated as deemed to be accrue or arise in India. That means it will be treated as accrued in India. Accordingly, this salary is taxable in India. Now, from this type of salary, if he is getting any allowances, or perquisite paid outside India by the government to a citizen of India for rendering services outside India is exempt under Section 10(7). What is allowance? What is perquisite? I am explaining in brief. Rest in detail we will discuss in our next chapter, that is called salary. First, try to understand perquisite. You may heard that suppose Mr. X is hired by Reliance Industries Limited, and Mr. X is getting what he is getting from Reliance Industries Limited against his job, say 1 lakh rupees per month as a salary. Okay, 10,000 per month for entertainment, that is entertainment allowance. Reliance Industries Limited also provide a car for personal as well as business use. Since this is provided in kind, the facilities which are provided by employer to employee in kind is known as perquisites. There are a few more, but for at this moment, try to understand the meaning of perquisite like this way. The facilities provided by employer in kind is termed as a perquisites. Okay, the car facilities provided by Reliance Industries Limited to Mr. X, an employee, is treated as perquisite, and entertained for the money given for a specific purpose, that is called entertainment allowance, is called allowances. If a government employee, Indian citizen, working outside India is getting any allowances or perquisites from government, it will be exempted. What is exempted? Allowances and perquisite. Then what will be taxable? This basic part will be taxable. We will again discuss this part in our salary chapter. Okay, got it? Was it clear to you? Next one. Retirement benefits like gratuity, leave encashment, etc., which are exempted to some extent. We will discuss this part in our subsequent chapter called salary and income under the head salary. Okay. Compensation for any disaster. What is it? Suppose there was some disaster like earthquake, etc. Government, either central or state or local authority, is giving some compensation to the person who are affected due to this disaster. Whatever they are getting is exempted under Section 10(10) BC. Clear? Any question till now? Do you have any query till now? Any query till now? Okay. Now next one. This is the important amendment made in Finance Act 2021. Try to understand what is it. Do you know life insurance policies? Anyone have any idea about life insurance policy? And what is it? Life insurance policy, what is it? There is no limit for compensation. Whatever they got, everything is exempt. What is life insurance policy? Do you have heard about Life Insurance Corporation of India or ICICI Lombard or MetLife or SBI Life? What they are selling, what they are giving, what they are providing to you? Any idea? Generally, what happened? Try to understand the concept of LIC. Suppose LIC is a company. I believe you heard about this name, LIC. They are selling life insurance. That means on happening of certain event, they will pay something to you. On happening of certain events, miss event, they will pay to you. How it works? They are getting some money from you. That is called a premium. Say you need on happening of certain events, some people may get some benefit. Here, the happening is death. In case of life insurance, the happening event is the death. That means on happening of this death of person who are insured, who is insured, certain benefits shall be given to nominee, which is already described by the person. That means there is a person called Mr. X. He is buying an insurance policy. He is buying an insurance policy for himself, saying that I will pay rupees 10,000 per annum to the company. Okay, if I dies, if my death occur, then you are supposed to pay rupees 5 lakh to my son. If my death occurs, then you are supposed to pay rupees 5 lakh to my son. For how many years? How many years? I will pay for say 10 years. And the risk coverage might be for 10 years, 40 years, 30 years. It might be depend on it purely contractual relationship. Here, Mr. X is considered a person insured. He is known as person insured. His son is treated as nominee. This 10,000 per annum, what Mr. X is supposed to pay to the company is known as premium. And this 5 lakh, which is basic thing, 5 lakh is supposed to be paid to his son on the event of his death within these years. This 5 lakh is known as sum assured. If suppose within this tenure no death occur, then LIC in general gives some maturity benefit. Suppose after 40 odd years, Mr. X is still alive. Then what LIC will do? They will return certain amount to Mr. X. They will return certain amount to Mr. X. That will be known as maturity benefit. There might be two type of different plans. If there is a term plan, then no maturity benefit will be there. But general LIC products covered this type of maturity benefit. This is called traditional product of LIC. That means if event is not occurred during this tenure, this is called tenure of the policy. If event is not happened, if event is not occurred during the tenure of the policy, the LIC company will give certain money to Mr. X. It might be 10 lakh or 15 lakh or 20 lakh, whatever be they written. It is called maturity benefit. Now question arise, what are the issue? Here they are paying money, 10,000 he is paying, and change the color of 10,000 they are paying. This is expenditure. If something happens, then his son got 5 lakh or 10 lakh, whatever the money he got. This is the what will be the fat of this income, how it will be treated in income tax law. And if death not occur, if there is no death, then Mr. X getting some maturity benefit. What will be the fate of this money received by Mr. X? We are supposed to discuss this part, this both part. That means if money is received by his son on occurrence of death within the prescribed time, and if death is not occurred, in that case, Mr. X is getting maturity benefit. Okay, we are supposed to understand what will be the tax treatment in both the scenario. Got it? What is the concept of LIC? Is it clear to you? Is it clear to you? Health insurance is not a life insurance. Health insurance is just for health. LIC is something else. Okay, a life insurance might be it is from LIC company, might be it is from ICICI, might be it is from HDFC. We are now focused on what will be the tax treatment of two receipts. One received by son on the happening of that event. If not that event occurred during the tenure, what will be the tax treatment of sum received by the person insured himself? Now, any sum received under a life insurance policy, any sum received under a life insurance policy, be careful, life insurance policy, it is not medical policy, and it is not saying that life insurance corporation policy. Life insurance corporation policy is another company for providing life insurance. There might be ICICI, there might be HDFC Life, there might be SBI Life. We are talking about policy issued by all this type of company, which is life insurance policy. Okay, got it. ICICI also issues say medical insurance, say your national insurance issues certain medical insurance that is not covered, but insurance which is against life is covered under section 10(10)(d), which may be issued by LIC, which may be issued by ICICI, which may be issued by HDFC Life or any other company. It's hardly matter to us. But the concept of insurance policy, what is insured, the life of the assessee is insured. Okay. Any sum received under a life insurance policy, including bonus on such policy, is wholly exempt from tax. That means when you are getting money, when Mr. X is getting money or his son is getting money, that is wholly exempted. No tax shall be payable on that money. Got it? However, this provision has certain riders. However, this provision has certain riders. So one thing you did not discuss about bonus. His coverage was 5 lakh, and on happening or not happening of event, he might get 10 lakh or 20 lakh, this type of figure. The difference, this is the sum assured, and he's getting 10 lakh or 20 lakh. The difference amount is bonus. What the insurance company add if there was for each year they are issuing certain bonus to their policy holder, and that bonus shall be added to your maturity amount. So here the sum assured, that is maturity amount, along with bonus money, is not taxable at all in hands of nominee as well as policy holder. Clear? However, this have certain rider. What are the rider? However, exemption is not available on any sum received under section 80DD. What is 80DD? We will discuss it in the chapter deduction. Right now, I am not going into that part. Any sum received under Keyman insurance policy. What is Keyman insurance policy? What is Keyman insurance policy? Any idea? What is Keyman insurance policy? If someone is asking, is maturity benefit and death benefit amount will be same? It may vary, and in most of the cases it is same. What is Keyman insurance policy? Try to understand something, a concept which is in insurance. Suppose there is a company. Suppose there is a company X Private Limited. Mr. X is the director of this company. Mr. X is the director of the company, and since it is a private company, Mr. X holds entire. Mr. X and his family holds 100% stock, 100% stake of this company. He is the key man of this company. What they did, what they are trying to do. If X Private Limited will pay salary to him, if X Private Limited pays salary to him, this salary shall be taxable in hands of Mr. X. This salary shall be taxable in hands of Mr. X. Now, instead of paying this one, what they did, the company bought a policy, bought a life insurance policy. Okay, bought a life insurance policy and pay hefty premium. Say on this policy, the company paid 10 lakh per annum. Okay, what are the company bought a policy for Mr. X. Mr. X is a key man person for company. The company is saying that if something happened to Mr. X, then my business will be hampered. Then business of X Private Limited will be hampered. On the happening of that event, LIC will pay us rupees say 1 crore, so that we are paying 10 lakh rupees per annum to them. On the happening of, on the occurrence of death of Mr. X, LIC company, the insurance company will pay rupees 1 crore to us. Okay, that is the concept. What they did, they bought a life insurance policy by paying rupees 10 lakh per annum as a premium. Who is insured? Mr. X is insured. Who is paying that premium? X Private Limited is paying premium. This is called key man insurance policies. The major hurdle is what? This 10 lakh is available as a deduction. From the point of X Private Limited, if we think about X Private Limited, this is business expenditure. Don't you think so? This is business expenditure. This is business expenditure. They are incurring certain expenditure in the interest of their business, so this should be allowed. So it should be allowed. They got a benefit of tax benefit of 10 lakh by paying this premium. Now what happened in general? Up to 3 years. Up to 3 years. Suppose the company don't want to continue this one. The company don't want to continue this one. Up to 3 years, if company decided this, at 3 years, the surrender value. What is surrender value? Suppose they said we will pay 10 lakh rupees per annum for next 10 years. But after 2 years or 5 years, they decided we will not continue with this policy. If this is the case, then they will surrender their policy. And on surrender of the policy, life insurance company, whatever the insurance company is, insurance company will determine surrender value of the policy and pay that money to the company, which is more or less than whatever they paid to the company. Now what happened? In general, we've seen that at 3 years, surrender value of the policy is 0. At 3 years, surrender value of policy is 0. So at this moment, company will say that I will not continue this policy. Now Mr. X will say, do one thing. The company is not interested in continuing this policy. Please give me that policy. I will continue that policy. Whatever the market value of that policy, I will pay to the company. What they are saying? Mr. X is giving a proposal to his company, that is X Private Limited, saying that please don't surrender the policy to the company, to the insurance company. Please give that policy to me. I will continue it. I will pay subsequent premium to the company, and you take whatever the surrender value, whatever the market value from me. How to calculate market value? That is surrender value. At this moment, if X Private Limited surrender this policy to the insurance company, they will got nothing. They will got nothing. So what Mr. X will say? Mr. X is saying that I will pay 0 rupees to you. I will pay 0 rupees to you. You give me this policy and I will continue with it. After 10 years, after completion of 10 years, Mr. X will got handsome amount from insurance company, say 1.5 crore. Say, these are the only rough example. What happened? How much money Mr. X paid? Only 70 lakh for 7 years. 30 lakh was paid by company X Private Limited and 70 lakh was paid by Mr. X. Got it? What happened? Without paying any tax by Mr. X, without paying any tax by Mr. X, money of rupees 30 lakh rupees of X Private Limited was transferred to Mr. X. Got it? What happened? What happened? Did you notice what happened? Any thought on this type of planning? Any thought process on this type of planning? What happened? I am again repeating. X Private Limited has paid 30 lakhs to the insurance company. If this money was paid to Mr. X, he is supposed to pay tax. If this money is paid to Mr. X as salary, he is supposed to pay tax. This money was paid to insurance company. Now, after 3 years, X Private Limited is saying that I am going to surrender it. Now, Mr. X intervene and he's saying that instead of surrender, please transfer this policy to me. Please assign this policy to me. I will take care of remaining 7 installment. So he will pay 70 lakh to the insurance company. 30 lakh was paid by X Private Limited. At the end of the year, 10th year, who will the owner of this policy? Mr. X is the owner of this policy. Insurance company will pay 1.5 crore or whatever the some assured benefit. What will the benefit to Mr. X? By this way, did you notice that 30 lakh rupees was transferred by X Private Limited to Mr. X without paying any tax? At the time when he got this 1.5 crore from insurance company, you are saying that whatever I'm getting from insurance company against my life insurance is exempted. So this 1.5 crore is exempted and this 30 lakh was transferred smartly by X Private Limited to Mr. X without paying any tax. Did you notice that one? Any doubt about this concept? So to curb this type of tax planning, what government decided? Government says that if you are getting money against keyman insurance policy, we will not give any exemption to you. To cover this type of misplanning, to cover this type of tax evasion, tax avoidance, what government decided? Government decided to incorporate Rider in section 1010D. What is the rider? If you are getting any money, under Keyman insurance policy, that money is not exempted under section 1010D. That money is not exempted under section 1010D. Got the intention? Got the clearance? What is happening? Any question till now for this one? This is happening in the market. After few many years, it was incorporated that the government noticed that by this way planning are done. Now they incorporated. I think 8 or 10 years ago this was incorporated. Earlier there was not this type of provision. Okay, now comes to next one. Any sum received under an insurance policy issued on or after this date, this particular date, after 1/4/2012, in respect of which the premium payable for any of the years exceed 10% of the actual capital sum assured. What is it? We discussed that Mr. S, excuse me, Mr. X is taking a insurance policy. He is paying premium of rupees, say 50,000 per annum for next 10 years, and sum assured. I believe that you know what is the meaning of sum assured. Sum assured is only 2 lakh. It is. I'm making it for 3 years. Sum assured is 2 lakh. Okay. Now, in general, what is happening? 50,000 per annum he is paying to the insurance company for 3 years. That means altogether he will pay rupees 1.5 lakh to the insurance company. On completion of 3 years or occurrence of death within these 3 years, the insurance company will pay rupees 2 lakh to Mr. X. If payment was made to nominee, that is two cases are there. Payment might, if death happened, then nominee will get rupees 2 lakh, and if no death, then Mr. X will get 2 lakh on completion of this 3 years. Okay. Now, think about this is called sum assured. If your premium money, if your amount of premium per year, whatever you are paying, is more than 10%, sum assured is 2 lakh. What will be the 10% of this? 20,000. If your premium money is more than 10% of sum assured, that means your premium amount is more than 20,000. Henceforth, deduction will exemption will be not given if there Mr. X got the money of rupees 2 lakh after 3 years. No exemption will be given. However, in case of death, nominee will get 2 lakh rupees. He will get exemption. Got it? The rider is that if you are paying premium more than 10% of sum assured, more than 10% of sum assured, then maturity benefit is not exempted. However, the nominee is getting the money after death of some person insured. The money is exempted in hands of nominee. Got it? Any question? Any question? Someone is asking, I think it is you are asking regarding Keyman policy. Yes, it is taxable, even though it is received by the company. Now, if this threshold limit of 10% is applicable, if policy is issued on or after 1/4/2012. Earlier, if policy is issued between this date If policy is issued between 1st April 2003 and 31st 3 2012, then this limit was instead of 10%, the limit was 20%. And if the person who is supposed to be insured is disabled, that means he is the handicapped person. Right now, you may understand that if the person is handicapped or he's suffered from some big disease like cancer, like TB, etc. In that type of situation, if the policy is insured after this date, instead of 10%, the provision is applicable for 15%. Got it? Clear? I think it is clear to you. Now come to our next part. This one, ULIP. What is ULIP? What is ULIP? Anyone have any idea about ULIP? Unit linked insurance policy. Any idea? Any idea about unit linked insurance policy? Okay, let me explain. Suppose in ULIP, you invested rupees 50,000 per annum. What insurance company will do? They are charging for two things. One is for mortality and another part is for investment. And few might be for certain their expenditure. I'm not discussing about this part. Mortality. What is the concept of ULIP? ULIP is saying that the policy, the value, how much you will get is linked with certain units. How much money you get at the time of maturity, it depends on the value of the unit. In our earlier example, the value was fixed, that is 10 lakh, 12 lakh or 20 lakh, sum assured was fixed. Now what happened in ULIP plan? In ULIP plan, what is happened? You may invest rupees 50,000 per annum in the ULIP plan. And you are saying that minimum I should require 10 lakh if some happening or happen. Okay, some mishappening is happen. Then for 10 lakh, the company will buy a mortality, that is term plan for you, which might be cheaper for you. Say out of this 50,000, 5,000 is considered for this 10 lakh for getting this benefit, and remaining amount after deducting certain expenditure part, say 44,000 shall be invested by the company into certain units, and that units again into market. That units invest money into the market. It might be equity market, it might be debt market. Considering your risk appetite, they will buy this type of unit. That means you're on happening of certain events, you get something, that is the insurance, and this is the part of investment. That means your insurance is linked with your investment. That means if the market condition will be good, then this might be any numbers. Say within 10 years, this might be market was very good, so this became 4 crore rupees. If market was very down, this may become 20,000 only. So what you will got? 20,000. This is the concept of ULIP. That means your insurance is mixed with, blended with insurance. Life insurance is blended with investment. Life insurance is blended with investment. This is the concept of ULIP. you are paying a single premium, say 50,000, 60 or 70, whatever the premium you are paying a single premium for both. On the back end, the insurance company will deduct mortality charges and remaining amount after allocating certain expenditure, they will allocate that money to your investment portfolio, which might be which depends on your risk appetite. That might be equity oriented, that might be debt oriented, and depending on the market condition, your return may vary. This is the concept of ULIP. Got it? Any question? Any question? What is the rider? Since it is also a life insurance policy, so ultimately it is also governed by section 1010D. In last financial finance act, the government inserted one rider in case of ULIP. What is the rider? Where any ULIP is issued on or after this particular date, 1st Feb 2021, and the premium payable for any of the previous year during the term of such policy exceed rupees 2,50,000. For example, suppose instead of 50,000, let's say instead of 50,000, you are paying premium of rupees 5 lakh per annum. Instead of 50,000, you are paying 5 lakh per annum. That means more than 2,50,000, and policy was issued on or after 1st Feb 2021. Then whatever you are getting back is taxable, is not exempted. Whatever you are getting back is exempted, is not exempted, shall be taxable. It shall be taxable. However, if yearly premium is within 2.5 lakh, then whatever you are getting is exempted. Got it? If during the year, people may do like this one. ULIP, he bought ULIP plan from ICICI, say 1 lakh. From SBI, 1 lakh. From LIC, 1 lakh. From HDFC, 1 lakh. Did you notice that each plan is within limit, that is 2.5? So what will be the whether the maturity benefit will be exempted or taxable? Act is very clear that Act clarify that to the extent of 2.5 per annum we will exempt. That means whatever you choose your policy up to premium of 2.5 lakh, whatever you got return, we will exempt that part. Remaining part will be taxable. Whether it is a single policy or aggregate policy, the limit is 2.5 lakh. It is fixed. Got it? Any question? Okay. There are certain exceptions. These are not exempted. However, there are certain exceptions to this situation. Point number 3 and 4 shall not apply to any sum received on death of the person. That means this one, we already discussed that. This one, point number 3, point number 4. That means the exemption will be available if amount was paid to nominee of the person insured on happening of certain events, that is death. Got it? Actual capital sum assured shall means the that we already discussed, and this part we will discuss while discussing capital gain. What will be the tax treatment of ULIP plan if I paid some insurance or yearly premium of rupees 3 lakh, that is more than rupees 2.5 lakh. If I am paying premium of more than 2,50,000, then how it will be treated? It will be certainly not exempted, but how it will be treated, which we will discuss in chapter capital gain. I am not discussing right now. Got it? Any question? Any question? Oh, someone is asking which chapter we are studying. We are studying income exempt from tax. Is it clear to all? Do you have any question? But why the term of this is mere example. It might be 5 years, 10 years, anything may happen. Okay, any more question from this provision? Now comes to our next section, that is section 10.11. Payment from statutory or public provident fund. What is it? Public provident fund. What is it? Any idea? Any idea what is public provident fund? Now, public provident fund, suppose we have very limited avenues for investment. If you have money, then surplus money, then you may invest in FD, you may invest in equity market, you may buy gold, and in this scenario, in this line, one more investment is called PPF, that is public provident fund. FD, you are getting interest, it will be taxable. Equity market, it is riskier market. If profit is there, it will be taxable. However, it is riskier. Gold market, again, when you sold this gold, it is taxable. And one more thing is that immobile property. But for investing immobile property, you required handsome amount of money, hefty money you required. So it might not be possible for everyone to invest in immobile property. So one of the small savings we can do by way of PPF, that is called Public Provident Fund. This is a 15 years plan which may be extended to till 20 years. You may invest money into PPF, that is a dormant security, 15 years, and you will get interest, and that interest is exempt in your hands. You may get interest around 7 to 8%, even below, even it is below below 8%. But whatever you are getting, that is a net. You are not supposed to pay any tax on this interest on PPF. Okay, there is a lock-in period of 15 years. There is a lock-in period of 15 years. That means once you invested money into PPF, then you cannot withdraw money within 15 years. However, it may be extend up to 20 years. After 15 years or 20 years, that money will be returned with interest accrued till that last date. Got it? This is the concept. It is not like that you are supposed to invest on yearly basis. Like insurance policy, suppose you bought an insurance policy, you paid rupees 50,000, and in next year there might be a chance that your financial conditions are not great, then it is not possible for to pay rupees 50,000 again. That is the risk in life insurance policies. In PPF, this risk is not there. If you have surplus money for this year, you invest in PPF, say 50,000. In next year, you might don't have this type of surplus money. You may invest rupees 500 only. This is the liberty given by the PPF. Got it? The concept of PPF. And one major advantages of PPF is that it is not attachable. Any payment from a provident fund to which Provident Fund Act 1925 applies, or from any other notified provident fund, that is PPF, by the central government is exempt. Whatever interest you are earning against statutory or public provident fund is exempt under section 10.11. That means there was one concept. Did you heard about this EEE? Did you know about this concept EEE? Anyone? This is out of the our discussion, but did you heard about this concept EEE? The concept EEE denotes, this is out of this chapter, but this is interesting to know. E denotes exempt. Okay, the PPF is an exempt plan. What is it? There are 3 points. What is it? There are 3 points. Number 1, investment. Number 2, interest, that is regular income. Number 3, return on tenure, on completion of tenure. In general, suppose you made FD. Investment in FD does not attract any tax, no tax. However, interest will attract tax. Whatever you are getting withdrawal money is not subject to tax. That means this is not EEE. This is ETE. Got it? On the same line, if we think about PPF, when you invest in PPF, whatever investment you have made up to rupees 1,50,000 is exempt, is deductible under section 80C, which we will discuss in our subsequent chapter. Whatever you earned from interest, whatever you earned in the name of interest for PPF against PPF deposit, it is also exempt. Where it is exempt? Here under section 10(11). And whatever money you withdraw from after completion of this tenure of 15 or 20 years, whatever you are getting, no tax is there also. That means this one is also exempt. That means you are getting E. That means at the time of investment you are getting exemption. Interest is also exempt and withdrawal is also exempt. This is called EEE. Got it? Now, what are the situation? PPF, we understood what is it. Exception. Our one rider that was introduced in last Finance Act 2021. What is it? Interest accrued during the previous year in the account of an employee maintained by the fund shall not be exempt if the employer is giving contribution and your employee's contribution is more than rupees 2,50,000, then this exemption is not available. And where employer is not giving contribution, in that case, up to rupees, if your yearly contribution is rupees 5 lakh, up to rupees 5 lakh, exemption is available. If after 5 lakh, exemption is not available. Got it? Any question? Entire interest shall be exempt in case of PPF. Any question till now? Here it is employer and employee contribution are there. There is one more scheme in PPF in Provident Fund. That is not PPF, that is a statutory Provident Fund. Generally, if you know about something about PF, there is 2 contribution. Suppose you are employee of certain company. Mr. X is an employee of A Limited. What he is getting? Salary. Apart from salary, PF contribution will be there. Certain portion will paid by employer from his own pocket, and Mr. X, his salary will be deducted by his contribution to PF. That is, employee is also paying and employer is also paying equivalent amount. This is called normal concept of Provident Fund. Employer and employee both are contributing to Provident Fund. At the time of at the time of completion of the tenure or at the time of retirement, both, that means employer contribution, employees contribution interest on this and interest on this will be paid to employee, that is Mr. X. Okay, this is also there. If the provident fund is a statutory provident fund, then this interest is also exempt. Both this interest shall also be exempted. However, one rider has been added. If employer and employee both are contributing, then employee's contribution for a particular year does not exceed 2.5 lakh, then it's fine. If it exceed 2.5 lakh, then interest amount shall not be exempted. If employer is not contributing, then employee's contribution exceed 5 lakh, then interest amount is not exempted. Got it? Any question? Any question? Any question till now? Someone is asking, what about the stipend received during training? That is not provident fund. This is taxable. Is it clear? Now comes to next point. Payment from recognized provident fund. The same concept is applicable. Only section number is different. That is 1012. Okay, I'm not going into detail again. Sukanya Samriddhi account, section 1011A. Whatever interest you are getting from Sukanya Samriddhi account is exempt. Some few more exempted income. I'm not discussing entire each and every item which is covered under section 10. You are supposed to go through in your study material for entire listed item. We are discussing very selective items. Now, few more. Payment from National Pension Trust. Whatever you are getting from National Pension Trust is exempted subject to certain rider, which we will discuss in the chapter deductions. Daily allowances, etc. to MP MLA. I think you understand what is the MP and MLA. Members of Parliament, members of Legislative Assembly. These allowances, daily allowances, constituency allowances are exempted in hands of MP and MLA. Awards and rewards. Whatever you are getting, any rewards and award and rewards from government is exempt under section 1017A, and few award and rewards from certain recognized authorities are also exempted. Family pension to widow or children of armed force is exempted. I think you don't have any issue with this one. Income of local authority. What is the meaning of local authority? You know that there are 7 categories of person. There are 7 categories of person. Individual. Someone is asking there whether investment in PPF is also limited to 10. No. There is threshold limit, maximum 1 year, 1,50,000. Local authority. What is local authority? At the time of discussing person, we discussed that there are 7 categories of person: individual, HUF, company, firm, AOP, BOI, local authority, and artificial judicial person. That local authority means municipal corporation, panchayat, etc. Their income, mainly their income is exempt under section 1020. What type of income are exempt? Income chargeable under the head income from house property, capital gain, income from other sources. Income from supply of commodity other than water or electricity or services within its own jurisdiction. Income from supply of water or electricity within or outside the jurisdiction. Almost all type of income earned by local authority is exempt. Did you notice that thing? Can we say that there is a salary income in hands of local authority? No. House property income, exempt. Capital gain, exempt. Income from other sources, exempt. There are 5 facts. Salary, no chance, there will be no salary income, so it will not be done. Business, in general, local authority is not doing any business, and if they are doing business within its own jurisdiction, apart from water or electricity, that are also exempt. And if they are supplying water or electricity within or outside their jurisdiction, whatever income they generate is also exempt. Almost all type of income of local authority is exempt under section 1020. Income of trade union, section 1024. What is the meaning of trade union? You can know that thing. Any income chargeable under the head income from house property, income from other sources of a registered union or an association of registered union. That means a union itself or a union which is framed of all registered or association of registered union. All are, both these income are exempt. Income of scheduled tribe. Following income of member of scheduled tribe is exempt. What type of? From any source in specified areas or states. What are the, for example, if a scheduled tribe is located in Arunachal Pradesh, then whatever be the source he is earning, that is exempt. By way of dividend or interest on any security are also exempt, provided he resides in specified area or states. Income of Sikhism. Following income of an individual. Which individual? A person from Sikkim is exempt. Which income? Any source in the state of Sikkim or by way of dividend or interest on securities is exempt. However, if Sikhism woman on or after this particular date marries on an individual who is not a Sikhism person, not from a Sikkim, is taxable. Any question till now? That's why I'm discussing all this part. Now, this is not exemption. This is the biggest hurdle. Suppose a person, think about a person. His PL is like this one. He's getting certain interest income, which is taxable interest on FD. He's getting certain income which is exempt. Okay, this is his income. He incurred certain expenditure. And as per computation, this income is exempted. So this one is, I'm putting some figure over here, 100, 20 and 50. I'm making it 60. So when I compute his net profit is 60, I will start from here, net profit 60 less exempt income that is not taxable, that is 20. So my income will reduce to 40. Now government is saying that this expenditure, this 60, can you sure that the part of this expenditure was not incurred by you for earning this exempted income? If this income is exempt, that is not supposed to be taxable, then any expenditure related to this income, directly or indirectly, that expenditure should also be disallowed. That expenditure should also be disallowed. How could you determine? If there is a direct link with this income, you may add back this one. But if there is certain common item for earning this, for example, bank charges or interest expenditure, if it is not possible for you to segregate the expenditure amount between these two, taxable income and exempted income, then you are supposed to follow rule 8D, and accordingly certain amount which are linked with your exempted income should be added back, which may be computed by your assessing officer. That shall be, say, out of 60, you think that 6 lakh is considered as a expenditure relating to this exempted income. So your total income will be 46. Is it clear? Any question? This is the biggest headache for practitioner. Is it clear? Now, last section in this series, 10AA. This is a serious section. Special provision in respect of newly established units in SEZ. SEZ means Special Economic Zone. What is the Special Economic Zone? What is a Special Economic Zone? Any idea? Any idea what is a Special Economic Zone? I'm sharing a story with you. What is it? Southern part of India. Suppose this area is underdeveloped. I don't know which state is this. This area of India is underdeveloped. To make it developed, what we required? To make it developed, what required? Industry. If industry will be there, then there will be employment. If employment will be there, people's expenditure capacity will be increased. Don't you think so? All of these are interconnected. All of these are interconnected. Don't you think so? Any idea? Now I'm explaining the concept of SEZ in very, that is not technical understanding, but just for your understanding at the level of intermediate. Why people will open industry over there? Why people will open industry over there? They will require some benefit. Suppose a person is opening an industry here, is got no benefit, and if the person is opening a industry over here, government is saying that we will not levy any tax. That is GST, for example, income tax for certain periods, blah, 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 blah. No capital gain will be there, etc., etc. There is so many benefits we will provide if you open an industry over here. Now the businessman will think that instead of opening industry over here, if I shift to this area, which is still underdeveloped, if I go here, then he may think that I may open an industry over here. But after analyzing the benefit, he thought that if I will open industry over here, for example, he raised a concern about banking. In this area, there is no bank. How could I run my business? How could I run my business? Think about a businessman like ICICI Bank. Think about a businessman like ICICI. If you approach ICICI, please open a branch over here. Please open a branch over here. ICICI will do some feasible study and decided that since this area is underdeveloped, if I open a branch over here, there is a risk. There is no revenue from this branch. This branch will remain in loss, so I will not open branch over there. So there is a ice between this. A businessman is not supposed to go there, though there are certain benefits. Why? There is no infrastructure. ICICI Bank is not supposed to go there. Why? Because there is no industry. So how to make arrangement for this? One developer will be appointed. One developer will appointed. He will contact this businessman. He will contact this businessman and saying that, sir, what is your problem? Banking facility is not there. ICICI is supposed to open their branch over there. Then he will approach ICICI. What is the problem? Reliance Industry is supposed to open their branch in this area. If Reliance is there, ICICI will say, I will also open a branch over there because there is a ample of business will be there. In this way, the ICICI branch comes here and industry will come here. Slowly and slowly, this area became developed area. This is the idea behind SEZ. What are they trying to do to develop this part of the country? They will say for the purpose of taxation, this is the not part of India. This is not a part of India, and accordingly they give certain benefits, some certain taxation benefits to develop this area. Got it? Any question? The understanding is clear? Now comes to section 10AA. Applicable to whom? Applicable to all SSE. Conditions to be satisfied. The SSE is an entrepreneur as defined under section this of SEZ. The undertaking, that means unit, has begun or begins to manufacture or produce article or things, that is should be industry, or provide service on or after 1st April 2005, but before 1st April 2020 in any SEZ area, special economic zone. The business of this undertaking should be not formed by splitting up or reconstruction of an existing business. That means the business should be a new one. However, this condition is not applicable where section 33B are satisfied. What is section 33B? I'm explaining. One minute. What is 33B? Now think. Suppose Mr. X has a business unit in, suppose in India, he have certain business unit. The business unit is running very fine. On one fine day, due to act of God, that is natural calamities like earthquake, flood, typhoon, etc., or due to riots, due to accidental fire, or due to war, whether it is declared or not declared, his business was hampered, his business was destroyed. And within 3 years, from the end of the financial year in which such mishappening took place, he revived his business. What is happening? What has happened? He have a business unit. Due to act of God or riots or fire or due to war, his business was destroyed. He is a brave man. Within 3 years from the end of the financial year in which this mishappening took place, he revived his business again. If this is the case, it will be treated as a new business. It will be not treated as a business formed by splitting or reconstruction of an existing business. Got it? New plant and machinery. Such undertaking should not be formed by second-hand plant and machinery. However, two exceptions are there. if you are importing second-hand machinery, from outside India, and that machinery was after importation, you are the first user of that machine, and no depreciation was granted to any person in India on that machine before your uses, that machine is treated as a new machine. That machine is treated as a new machine. Suppose, for example, you required a machine that original cost is 1 crore and your budget is very tight. You got a 20 lakh option to buy a second-hand machinery from London at the cost of rupees 20 lakh. Since this machinery you are importing from outside India, the machine is second-hand. The machine is never used in India before your uses, and no depreciation was provided on this machinery under income tax law before your uses. If this is the criteria, then this second-hand imported machinery shall be treated as a new machine, shall be treated as equivalent to new machine. Okay, got it? And number two, suppose altogether you are investing rupees 100 lakh in your plant and machinery. Out of this, 20% in value, that means up to 20 lakh machinery worth of second-hand machinery is allowed to you. Okay. That is new plant and machinery. Such undertaking should not be found by transfer of machinery or plant which is previously used for any purpose. However, there are two exceptions. Imported second-hand foreign machine and 20% second-hand machine is allowed. This one is treated as a new one, and this one second-hand machinery, Indian bought second-hand machinery, shall be allowed. And a report from a chartered accountant is required, which you are supposed to submit within 1 month prior to the due date of filing return of income. If all these conditions are fulfilled, then for first 5 years from the commencement of operation, whatever you earn from this business, multiply by your export turnover divided by total turnover. This formula, whatever income you compute by this formula, shall be exempt. That means if you earned, say, rupees 10 lakh, if you earn 10 lakh, your export turnover is, say, 10 crore and your total turnover is 15 crore, then whatever the result of this formula will be exempt in your hands. For next 5 years, this formula multiplied by 50%. That means half this formula. However, half of this formula shall be allowed as a deduction under section 10AA. For next 5 years, same 50% will be allowed as a deduction. However, there one condition will be attached. That means that is such profit must be credited in reserve account called SEZ Reinvestment Allowance Reserve Account. That means you cannot take away this profit. This profit should be transferred to SEZ Reinvestment Allowance Reserve Account. And how to utilize this reserve? Utilization of such reserve, you are supposed to buy new machinery or plant within next 3 financial year. If you misutilize that money, then the misutilized money shall be treated as your taxable income. I'm not going into that part. You please read this thing into your home. This is your homework. Any question, any query till now? First formula once again, I am explaining. Suppose your profit from that undertaking is 10 lakh. Your export turnover is 10 lakh, and your total turnover, that means export plus domestic turnover, is 15 lakh. By applying this formula, whatever you are getting is exempt for the first 5 years from the date of commencement of your operation. Any question, any query? Now we are discussing something called tax planning, tax avoidance, and tax evasion. What is it? Any idea? Any idea? What is it? My notes will be these slides will be available at ecoursepoint.com free of cost. You may view those slides, but obviously not a downloadable. You can view at any number of times. Again, explain section 10AA. Please read it in your home. Again, I am explaining. It is applicable to all SSE. What are the requirements? What are the conditions? The SSE is entrepreneur as defined under section this. The undertaking is supposed to start the manufacturing process after this date, but before this date. The business should be new business. That means it should not be formed by splitting or reconstruction of any existing business. However, if the business is revived under section 33B, it will be treated as a new business. What is 33B? We already discussed that due to mishappening, due to certain act of growth or accidental fire, riots or war, your business, the business of someone is destroyed, and within 3 years, from the end of the financial year in which this mishappening took place, he revived his business. That business is treated as a new business. That means this condition is presumed to be fulfilled. Next condition, there should be new plant and machinery. However, two exception are there. Imported second-hand foreign machinery is treated as a new machinery, and out of total value of the plant and machinery, 20% second-hand machinery is allowed, and a report from chartered accountant is required to be uploaded. If these conditions are fulfilled, then for first 5 years from the date of commencement of operation, the profit is exempted by applying this formula ET by TT, and for next 5 years, 50% of this formula is allowed, and for next 5 years, 50% of this formula is allowed, but subject to one rider. What is the rider? The profit should be credited in reserve account called SEZ Reinvestment Allowance Reserve Account, and that money should be utilized in acquisition of a new plant and machinery within a prescribed time limit. And if you misutilize this fund, then the profit shall be taxable. Got it? Any question? Any question? Any question till now? SEZ, Special Economic Zone. Now comes to tax planning, tax avoidance, and tax evasion. What is it? Try to understand. Tax planning is the way to reduce your tax liability by taking whatever the advantages provided by the act, like some exemption, like deduction, like rebates, relief, whatever the mechanism, whatever the provision stated in the statute books, you are taking the advantages of those provisions. That means you are planning, you are reducing your tax liability as per the planning of the government. Say government is saying that if you made medical insurance, we will give certain deduction of ₹25,000. Then you are making investment in medical insurance. That's fine. If LIC is required and you will get certain, and as per that provisions, you are reducing your tax liability. That is termed as tax planning. Got it? This is termed as tax planning. Tax avoidance. You are taking advantages of misinterpretation. That means, suppose Act is saying that up to rupees, for example, you are taking the loophole in the, you found as loophole in the Act. In the script of the Act, you found certain loophole, and you are utilizing that loophole to reduce your tax burden. Tax evasion means you are using illegal way to reduce your reducing your tax liability. How? you are suppressing your sale, you are increasing your expenses, you are not investing money, but you are saying that I invest it and so I am eligible for deduction. That way, reducing your tax liability. That is illegal way. It is surely it should not be done. Tax management, that means compliance. That means compliance of tax law. You are supposed to file return of income. Yes, you are filing return of income. You are supposed to pay TDS. Yes, you are paying TDS within time. That is the called tax management. What will be the benefit of proper tax management? If you are managing your tax properly, that means you will not got any notice. There is no hurdle. There will not smooth functioning of your life will be there. Got it? Got it? What is tax avoidance? This is the best line. Tax avoidance is a practice of bending the law without breaking it. Tax evasion is illegal both in script as well as moral. Morally as well as script wise, you are doing wrong thing. This is tax evasion. This is a crime. You cannot do that thing. Whether tax avoidance is illegal or illegal, there is a very different thought process. Few thought process are saying that tax avoidance cannot be. It is a genuine way to reduce tax liability, and one thought process is saying that no, it is also a wrong process for reducing tax liability. Got it? Few more. Tax planning is futuristic and positive in nature. Tax avoidance is futuristic but short term. Why short term? Government will comes to know about this loophole and they will curb this one in their future amendments. They will remove these loopholes, etc. Tax evasion is a very wrong thing. It is a crime. You cannot do this from. Benefits. Tax planning give benefit in long run. Tax avoidance give benefit in short run. And this is the very wrong. This do not give any benefit, but it may lead to penalty and prosecutions. Got it? Any question? This part is covered in your study material. Basic concept. Please go through it. Your study material is provided by me, so don't worry. Whatever we are discussing over here, it is already covered in your study material. Word to word, it is covered. Now comes to one concept: diversion and application of income. This is try to understand this concept. It will help you in your subsequent chapters. Diversion of income and application of income. Think about the situation. Suppose you are an author. You are an author. You with your friend write some book, say called income tax. Okay. Simple. Income tax, simple. This is the title of the book. You wrote a book with your friend. You both are co-author. Okay. The royalty, the book was published by a publisher. And royalty is fixed at rupees 2 lakh. 1 lakh for each. 1 lakh for each. Okay. For the sake of convenience, entire royalty money was paid to you. Entire royalty money was paid in your bank account. And after getting that royalty of rupees 2 lakh in your bank account, rupees 1 lakh you paid to your friend, which is co-author. What do you think? While computing income of this person, whether his income will be rupees 2 lakh or rupees 1 lakh? What is your thought? He got rupees 2 lakh from publisher, and out of this rupees 1 lakh he paid to his friend who is also co-author. There is a deed between these three parties. That royalty will be 1 lakh each. Like all other provisions are there. Everything is written, everything is documented. Then what is your thinking? Whether what will be income of this author, whether it is 2 lakh or 1 lakh. What is your suggestion? This case, only 1 lakh shall be considered as his income, and this 1 lakh, though it is received by 2 lakh was received by him, but since there is already he is legally bound to transfer this 1 lakh to his co-author. This is termed as diversion of income. At the moment he got this money, there is a diversion, there is a fixed that this rupee out of this 2 lakh, 1 lakh is supposed to be transferred to co-author by virtue of this document. So he cannot at any moment of time, he cannot claim that entire rupees 2 lakh belongs to me. If this is the situation, this is known as diversion of income. Okay, and on the contrary, one more mechanism was there, application of income. Suppose you got salary of rupees 1 lakh. Suppose you got salary of 1 lakh. After getting this salary into your bank account, what you did with this 1 lakh? You enjoy in a hotel for 5,000. You created an FD of rupees 10,000. You donated rupees 2,000. And you did so many things. So can I say that while computing your income, shall I reduce this 1 lakh minus your party expenditure 5,000 minus your FD 10,000 minus your donation money 2,000? Can I reduce this part and say that your income is 83,000? Can I say this one, or can I say that entire 1 lakh rupees is your income? What is your thought? What is your thought? Entire 1 lakh shall be considered as your income. You are not eligible for reducing this one as reduction from your income. Why? What is the difference between 1 lakh transfer to your co-author, and what is the difference between you transferred certain money to your hotelier, your bank, or your donation? That means there, at the moment you got this money, there is no pressure on you to use this money in this way only. At the moment you are getting that money, you may say that this money belongs to me. I am the owner of this money. As per my will, I will expend this money, whether by way of hotel, by way of FD, donation, etc., whatever you can do, that is your money. That means when income is taxable, when you got the income, it is taxable. Now, since at this point of time you are saying that this is my income without any other rights, this is your income. After these things, what you are doing, this is known as application. You are applying your income, what is your income, you are applying as per your will. All these are application of your income. For all these things, you are not get any benefit, you are not get any deduction, or irrespective, unless and until any special provision is there. Unless and until there is special provision, you will not get any deductions from this income of rupees 1 lakh. This is called application of income. And in earlier example, at the source, when you got that money, you know that out of this 2 lakh, 1 lakh belongs to my co-author. That means legally you are supposed to give that money to your co-author. That is diversion of income. And here this is known as application of income. Any question from this concept? Anything? This concept will help you in subsequent chapters, diversion of income and application of income. Try to create a difference between these two things, whether on expenditure, whether you are applying your income, whether it is a case of application of your income or whether it is a case of diversion of income. Be careful. In case of diversion of income, the income which is diverted to some other person shall not be taxable in your hands unless and until specifically mentioned. In case of application of income, the whatever income you applied after reaching in your hand shall not be available as a deduction in your hand unless and until specifically mentioned. For example, this one, if you provided certain donation to a charitable trust, there may be certain deduction if it is specifically mentioned under any specific provision of 80s or etc. whatever. Unless and until this is specifically mentioned, no deduction shall be available. You did not get any reduction from your income for this application. Any question? Any question? Any question from today's session, this session as well as afternoon session? If you have any question, I am here to resolve you. Today we have time. In next from subsequent session, we did not got ample time for question and answer. We will start with salary income, which is out of 5 heads of income. That's first heads of income, that is salary. We will discuss on that part, and these are the very lengthy chapters. Any question you have in your mind, you may ask. This will be recording will be available after a couple of days. You may better ask from ICMI Institute itself. For administrative type of question, I am not a correct person to answer. Okay, if you have query regarding your subject, your topics, I'm here. But regarding your administrative, I'm not correct person to help you. Any other question? Someone is asking the difference between application and diversion of income. Application of income is not an allowable expenditure. However, diversification of income is that the income which is not your income. That means that income is not taxable in your hand. Your tax will, you are not supposed to pay tax on that amount. This budget will not work for you. If you are appearing in June or December examination, this budget finance bill 2022 will not for you. Your applicable finance act is 2021. Don't worry about that thing. I think study material is already available, or within couple of days it will be available. Sir, what about income from house property? After completion of salary chapter, we will go with income from house property. Don't worry about that thing. Any further question? Sure, the recorded video will be available at official ICMI YouTube channel. Don't worry about after a couple of days. And this PPT will be available at this ecoursepoint.com. It is available at in presentation segment. You will get PPT for view. Any more question? Any other thing? Okay, that's great. There is no doubt. This one is great. compliment for me. Hopefully you enjoy the session. From next session, salary we will start, which is a very vital topic for your syllabus, and try to revise till now what we studied. Please revise. Income tax is a very volatile subject. It will be vanished from your mind after a couple of months when you remember that what is basic concept, what is the tax rate, you will forget all these things. Try to repeat yourself. Revision process should be continuous way. If you revise your taxation, whether it is direct or whether it is indirect, you are supposed to revise n number of time. Suppose this chapter is completed today, you are supposed to revise from basic concept, residential status, agricultural income, and this one. Got it? That is the way to succeed in tax. If you are revising, if you are expending half to 1 hour, half hour to 1 hour daily basis, then direct tax should be on your fingers. I'm guaranteed that thing. ecoursepoint.com. No, in that case, no. Thank you, sir. Thank you for your compliment. Study material, I believe, is prepared in very handy manner. It's prepared by me only. So don't worry about the study material we provided is best material to you. Don't worry about it. As per my belief. Any other question? We will meet on 31st 5 to 7 session with salary income, which is a very vital, very important chapter in your syllabus. Thank you. Hopefully you enjoyed the session. Thank you.